Hey, welcome back to Two Super Guys Trade Stocks. I am Dylan.
And I'm Vinny.
And Burry put out a tweet that is amazing, a lot of information, and we're going to look at one stock that he kind of ominously is pointing to and another stock that I have already bought. We're trying to take advantage of this bank crisis. So anything we can do to get better deals, right? Let's look into it.
Two Super Guys Trade Stocks.
Yeah. So it looks like he's trying to show the intersection of kind of risk here, if you will, a little bit.
Yes.
So across the x-axis you have percent of unrealized losses as far as their capital trans one. And then on the y-axis here, you have percent of deposits that are not FDIC backed at the $250,000 limit, which the Federal Reserve has basically overrode at this point in time and said it's no. But which institutions were at highest risk, I guess you would say overall? Obviously, SIVB is way out there in the freaking corner.
Way out in the moon. The worst of both worlds.
Mm-hmm.
You could say the y-axis, the risk is a lot less now because they've already come out and said hey, we're going to back everything. However, they're still at a risk for bank runs. Okay.
Mm-hmm.
What is a bank run?
It's liquidity crisis, right? They don't have enough cash per se on hand to meet the demand of withdrawals.
Right.
That's like at 42 billion in one day.
Exactly. Right. So a bank run occurs, large group of depositors withdraw their money. Everyone gets scared. They all just take all their money out, which led to the 2008 financial crisis. It's important to note that this theoretically could happen to anyone. Let's take like JP Morgan. Okay, they're probably the safest one right now. If every single person took every dollar out of JP Morgan at once, they would be dead. Right? That's not going to happen. I don't know how people would coordinate that. It wouldn't be very nice. But theoretically, every bank is at risk. But the more risk inherited that those banks took, you have a higher chance. So this is a busy slide. I understand, but we're going to take a look at this. Okay?
I like the two that are labeled dead.
Yeah, dead. So what is this? I understand. This is insane. Now, when this crisis started, what I did was Michael Burry put out this tweet, and he etched in this little PACW, right? This was not a part of the original chart. So what I did was I looked at March 8th, the closing date, to now, the closing date of March 18th or March 17th close, and looked at the drop in each stock. Now, these, outside of the purple, are regional banks, okay? Now, obviously, SBNY, they're not really dead. It's a different situation, but you can't invest. SIVB, dead. FRC up here, negative 80%. If you look kind of the top going under SBNY, the higher the risk, the worse they are doing. Okay? Wow. So what everyone wants to know is, how do you take advantage of this? Why don't I invest in FRC right now? It's down 80%.
Yeah, someone asked that in one of our last videos because definitely considering it, but
why not? Right?
Didn't pull the trigger.
Right. And I have not either yet. I have invested in my other one that I'm going to talk about. But let me move my face here. There's one more stock, HBAN, 28.4%. So PACW is also down 65. That's why it's in red. WAL down 56. But if you look in the risk categories, if I wanted to invest in one of these banks just for a long-term hold, which one, it is risky. Like we said, any bank can have a run on it. Okay?
Yes.
I want to look at the biggest drop, so I'm getting the best deal for my money, which also has the least amount of relative risk. Okay? So by doing that, all of those are eliminated. These are dead, right?
Yeah.
Because they have more than the median of unrealized losses, hence more risk. They also have higher deposits, even though that isn't as risky now. Theoretically, if people go to withdraw their entire account, it's a larger sum of money, right?
Yeah.
That's why FRC and WAL are down 60 and 80%.
Yeah.
Right?
Makes perfect sense.
So your safest little cluster here is going to be CFG, NYCB, MTB, PNC, RF, and PACW.
Mm-hmm.
Now, what's weird is how much they're down. Why is PACW down 65%?
Yeah, interesting. That's PacWest or something like that
Yeah.
bank, I believe. Yeah.
PacWest. So
Yeah.
the first thing I was like, all right, wait, do they have anything to do with crypto? Like, because I don't want to touch this.
Yeah.
Like it was, but I couldn't find anything unreasonable like with crypto, like Signature Bank, for instance. Signature Bank was shut down, and it was just whatever. I don't understand why this bank in particular is getting hit so hard. So at first glance, I was like, I don't want to touch this, but as I'm going to show you with this other stock, there's a whole nother sector that's getting hit unrealistically hard. And there's kind of a fear psychological factor at play. All right?
Okay. I like it.
During these times of banks crashing, or really any sector, take chips, it doesn't matter. Let's say AMD, NVIDIA. They could have the equivalent business, which they don't. They could have the equivalent business. If one starts dropping 10%, people just start selling. They just get scared, right? So theoretically, you're going to have one outlier. Here is PCAB. Let me move your face.
Okay.
They essentially they came out. They had a letter before this saying like, "Hey guys, we're fine. I don't know why we're losing so much money." They have 10.8 billion as of Friday, just in solid available cash. Which a regional bank is a lot smaller than Bank of America, Wells Fargo. Which, by the way, did you see how far Bank of America is on this chart for unrealized losses?
I was kind of surprised. For the large banks, they're a little over there as far as like the actual percent of unrealized losses that they're holding on their balance sheet right now. That's kind of
I'm going to get into that too. Because I was looking at, should I buy Bank of America? The answer was no, full disclosure. But so they have a bunch of cash, right? They then came out. Let me move your face again. So since Monday, March 13th, net outflows have fallen sharply, with deposit balance fluctuations substantially stabilizing. So they're getting to a little bit of a healthier place. Pacific West Bank said as of March 16th, so Thursday, insured deposits accounted for over 62% of total deposits, which is why they were on that lower axis. And while insured venture-specific deposits made up more than 77% of total venture deposits. So they're not taking the same risk. They're really not. Okay. Now, I don't want to recommend, I'm not Jim Cramer, right? I'm not going to throw out, hey, buy SIVB or anything like that. But I am going to be honest. I am waiting for the rates, our March 21st and 22nd, to possibly pull a position in PACW. It has fallen significantly more than its peers, and it doesn't really make a lot of sense. Now, there are always other factors. You should never just look at, well, this one's down the most, let's go for this one. In this specific bank run risk, having a smaller amount of unrealized losses with a smaller amount of large depositors is a good thing. So
yeah, it makes sense. You're looking at performance relative to peers, which is, I guess, comparison. That's also why they come down, right? Because when their peers are having a bad day, it's kind of assumed that they're experiencing similar issues. That I get the logic behind it.
right. Insert Schwab. Okay. Let's look at these ETFs. So the XLF, that's just a financial ETF. KRE is regional only. Okay. So your big banks, as you remember on that chart, BAC is farthest to the right with the most unrealized losses. JPM was relatively safe. Citi was actually slightly safer, but they had higher. Yeah, I know. I hate that stuff.
Yeah. Citi is like kryptonite to me. I don't touch it anymore.
Right. When you look at regional banks, you have these massive down ones. These all had pretty high holdings in KRE. I'm going to go back one second. So FRC, there we go. So your CMA is here, your FRC is here, your EWBC is here, and your WAL. So those are all in there. And then you look at PAC, and it's way down here. It's not really in the same risk category.
Okay. I get the logic, yeah.
All right. Now, then I was looking, well, why are other financial institutions going down? Like brokerages, for instance, it's not really a direct risk. It's a different situation, right? It's like, when you like naturopath versus orthopedic surgeon. Like they're in the same field, but not really, right?
Yeah. Kind of.
So you have your banks, brokerages, and then combos. So Goldman Sachs down 13%, Morgan Stanley's 12, Fidelity's 13, Interactive Brokers 15, and Schwab is 26.
I believe Schwab's had the largest portion of unrealized losses in their balance sheet, though. That was why they were getting hit so severely.
A little bit. And here is something that I would like to show. This is the CEO.
And we have to address what's happened with your stock first and foremost. It's not necessarily the first place you'd think about for contagion after a collapse of a bank in Silicon Valley that did a lot of lending to venture capital firms, but that's what's happened. Your stock is down almost 30% over the past week, including today's bounce. Why?
Why indeed?
Well, I think there's been a degree of confusion on two sides of our firm. The first one is the difference between a brokerage operation and a banking operation. I see people speaking about FDIC, and they have a fairly good understanding of that when you deposit at a bank, the bank takes those deposits and invests them. They are part of the bank balance sheet, and then the FDIC provides insurance up to $250,000. At least that's the way it's been since, I believe, 2008.
About 2 more minutes.
Brokerage assets are completely different. So we have about $7.4 trillion that clients have entrusted us with at Schwab. And over $7 trillion of that sits on the brokerage side. Brokerage assets are held separate. They are segregated from Schwab.
So 7.4 trillion, 7 trillion brokerage
side. This is done under
side.
what's called the SEC Consumer Protection Rule. And so those assets are not commingled with us. I even have heard some pundits talk about SIPC and tried to compare it relative to FDIC. And of course, there's no comparison. These are segregated assets, and SIPC kicks in largely only in a situation of fraud. Of course, the SEC requires us to report on the segregation, and we do so regularly, and they audit it. So I think that's the first bit of confusion that went on. People began to conflate SIPC and FDIC and didn't really understand the segregation of client securities from the rest of Schwab.
This is where it gets interesting.
But you do have deposits, right? I mean, you do have a pretty robust bank business inside of the company.
We do.
And that, I think, is where the concerns are.
We do, and that's the second one that I want to try to address. Our bank is very conservatively managed. If you look at the holdings of the bank, we have about 10% of client deposits outstanding in loans that are over-collateralized almost exclusively to our clients, very, very low risk. And then we have about 80% in U.S. government-backed paper. Within that, you're operating with virtually no credit risk. From a liquidity standpoint, we have access to very substantial liquidity. Arguably, we have a level of liquidity over a 12-month period equal to our entire bank sweep deposits, around $280 billion. So I understand that there were banks that got into trouble. We have a reasonable understanding as to how they did so. But those applications, we don't believe, apply at Schwab at all. We do understand, though, that when our stock price went down at a rate that was in some manners consistent with some of the regionals, that people easily put us up on slides and talked about us in a manner consistent with some of the regional banks. Completely different model, completely different. You mentioned earlier that 80% plus of our deposits in FDIC insured balances,
insured.
Banks that have run into trouble are at fractions of that number.
But as you say, you've been swept in. Have you seen any deposit outflows?
Really interesting.
What are you seeing from customers?
No, actually, what we're seeing is asset inflows to the firm in significant numbers. So in February, our clients brought in almost $42 billion in net new assets to us. March to date, they've averaged about $2 billion a day. Interestingly enough, last Friday, when we were maybe at the heart of the peak maybe of some of these challenges before the actions taken by the Federal Reserve around liquidity, our clients actually brought about $4 billion into the firm that day alone. Another interesting factoid, the number one stock that our clients bought on Friday was Schwab stock.
Schwab.
I love it. Granted, he's the CEO, right? So he's supposed to give you a very rosy
grain of
picture.
salt. Grain of salt, right? You can, salesman, you can never trust, be like, oh, well, this is the best used car possible, right? But all that stuff can be fact checked, and that's where that gets really, really interesting. I've been trying to add Schwab as a position. I'm currently at 60 shares, average price, I think 58. I'm not going to buy any more unless it drops down to the 40s, which I'm really hoping it does, because I would like to have 100 shares. But to me, PACW, which I don't own yet, I'm waiting, and Schwab stand out as possible opportunities for long-term holds. There's volatility here. You got to be safe. Don't just blindly buy this shit. But in my opinion, that's what I'm doing.
Yeah, interesting. I sold a cash secured put for 100 shares of Charles Schwab at 55 strike, expiring April 17th, I think it is. I got like $420 in premium for selling that option. So my cost basis on it, if that gets exercised, would be like 50-80 or something like that a share. So I'd be looking to buy Schwab at any point around that price. It was my thought. I mean, this is not like very deep dive. Valuing banks and financial institutions is very, very hard. This was just like, this seems like a really strong resistance kind of level is kind of what I thought.
Yeah. And then on top of that, when you have regional banks that are getting rough, people usually move to a safer option. That's what JPM is like, having a semi-bad week. It's not even like here's like down 8%. But those are the two I'm looking at, guys. Let me know what you guys think. Give us like and subscribe if you don't mind. There's a little graphic. Ooh, fancy. All right.
Love it. Yeah, so fancy.
Later,
Catch you guys on the next one.